All right, everyone, we are back with part two of our interview here with Matt Burpee from Kepler Capital. Again, if anyone didn't see part one, we'll make sure we include the link, thumbnail somewhere on the screen. But purpose of today's video is to continue our dialogue relative to how private equity investors, acquirers actually look at deals, what things they look for, what things they don't want to see, the good, the bad, and the ugly, and everything in between. So here's a nice, simple question for the next one. How do you value a business? We've always said, you kind of go from that Charlie Munger, Warren Buffett ideology that the way we say when someone says something's cheap, we say it's not cheap, it's just accurately priced and it's bad. And so we always say, the deal, a good company at a fair price is usually better than a fair company at a good price. But that's from our side of the table. But love to hear kind of just high level thoughts when you say, okay, we're kind of valuing this business. How do you look at valuation?
So I use that same quote with our team. I think that ultimately we need to be careful not to overpay because the entry price in a deal has a dramatic impact on your overall returns as a buyer.
Sure.
But as long as we feel like we're paying a fair price, we need to do everything we can to maximize the quality of the business we're buying, because that also has a dramatic impact on your returns. And for us, we're not EBITDA times multiple equals valuation. That's not our approach. We spend a lot of time focusing on what we feel is the sustainable level of free cash flow for the business. What's the EBITDA? What's the capital expenditures required every year? What level of working capital is required every year? What level of cash is required to be kept in the business just so that we can all sleep well at night?
Sure.
What's the debt service capability? And ultimately, we run that through a financial model and we use multiple scenarios. We'll look at what's the realistic upside case here, what's our base case, and how bad does it get if things go sideways?
Sure.
And we try and weight all those different scenarios together and come up with a number. And oftentimes, small tweaks to those assumptions can have wild swings. And I think that's how I earn my salary is trying to pick a single point within those wild swings. And some of that honestly comes down to gut feel. How much do I trust the seller based on the interactions I've had? What are my past experiences in this industry or a similar industry? And in some cases, what's my trust in the advisor? Is this someone I've worked with before? Do they tend to have high quality businesses that they're representing?
Sure.
And you piece all that together and plug your nose, cover your eyes, and hope for the best.
I know what you mean. No, we try to do the same on our side is that the joke about bankers is like the upside looks like this, the middle case looks like this, and the downside looks like that. And it's like they're all, tremendous outcomes. But in reality, we always try to say that let's kind of preemptively audit the company, if you will, as to kind of like what are the weak points or what are the questionable areas relative to growth. And it's not necessarily weak as much as it's just maybe opaque, right? Things that are just not clear, that the clarity of which will provide adequate certainty to substantiate a higher value or a better structure. And I think addressing those head on and having kind of, like you said, most things in business sit behind a few hard conversations, right? But having those dialogues as opposed to just like, blindly saying, this thing is just up and away. So agreed. Appreciate that.
Just to add to that, the
Please.
thing we try and do in our offers, and this is new just in the last 2 years, is we put an assumptions page at the end where we say, this is what we know about the business. This is what we assume to be true. And obviously, one of the assumptions is your EBITDA is X, but sometimes there will be other factors in there. We assume that your contract with this customer will be renewed in the near future, or we assume that all your employees are going to stay. If there's a critical qualitative piece of the deal, we want to get out in front of it and make sure everybody understands that this is an important part of the deal and we need to be comfortable that it's accurate. And it makes our diligence process way more efficient because we go into it and the seller knows these are the 3 areas we're going to focus our time on. And if we can get comfortable with them, then good. We'll get to a close very quickly.
Sure. No, I appreciate that because I think there's some buyers to some extent that when you chat with them, they say, I really want the deal. It seems wonderful. It seems great. It seems excellent. And I say, I'm happy that you feel that way. However, specifically delineate what would make you not feel that way, right? Because then it's almost like inverse thinking. If you know all the things that can make a mess of something, like then we can, what was the old quote? Like, tell me where I'm going to die so I don't go there, right? Like,
Yeah.
it's the same in business where it's like, let's highlight the landmines and that way we know very clearly like what's going to make this tide kind of change the opposite way should one of these things manifest themselves in the process here.
Yeah,
Wow.
completely agree.
Very good. When you guys think about, so say you kind of land around value and where you feel comfortable with that in a deal, how do you then go about structure? What's kind of the thought that allows you to kind of pencil out how much is that closing, what's over time, what the contingencies are, and et cetera from there?
Yeah, it's a really interesting question. And I've never heard that saying before, but I like it. I'm going to start using that one. Maybe we'll put it into one of the LOIs we give you.
There we are.
So we have certain parts of our structure that are malleable, that can move around based on factors specific to a deal, and certain parts that are just fixed and fundamental to how we operate. From a fundamental standpoint, we are majority buyers. We never buy 100% of a business. We never buy less than 50%. We generally like to end up somewhere in the 70 to 80% range. And the theory behind that is we're not operating the business day to day. Whoever is should be an owner. We want them to think like an owner. We want them to think like a partner. Well, they should fundamentally be a partner. And oftentimes that is the seller. And there's some desire from the seller to stick around post-closing, continue growing the business, and have a second bite of the apple. And so they want to de-risk, get a large payout, but then still have the equity upside. So they'll continue to hold 20 to 30% of the business. Or in some cases, it's another person within the management team, or in some cases, it might be someone external we bring in to take over that management role. But fundamental to us is that we want to have a partner who is an owner in the literal sense, not just the figurative sense. So once we get past that large structural hurdle, the rest of the deal tends to be pretty vanilla. It's mostly cash at close with a small seller note, and the amount of cash at close comes down to what level of bank financing can we get comfortable with. And we want to have enough bank financing to help our returns, but it needs to be responsive to the check marks the bank needs, a certain level of cash flow and asset coverage. And it also needs to be a level where I can still sleep well at night, where I know that in my downside case, I'm still making all my payments on time because I'm risk averse at heart and I like to sleep well. So we kind of piece all those concepts together and come up with an amount that we're comfortable with. And the seller financing is sort of the plug the gap for whatever's left.
Sure. Okay. No, that makes good sense. And look, from our experience, there's sometimes a hesitation relative to this, to kind of rolling equity on some of these situations or taking seller note. But really, again, if the quality of the acquirer is there, we've found that those have actually been like the upside surprises of deals. We've had clients where we sell 80% of the company and 20% they're rolling forward as an equity, the new kind of iteration. And they say, Arthur, I'm happy with the 80%. So when that other thing becomes a zero, and I said, wait, like we're never selling. We've never had a situation where a seller has held either paper in a seller note or rolled equity forward where it is not materially kind of been a return above just the principal. So I think, just as much as you guys are kind of making bets on people you are buying, we are making bets on the people we're selling to, and we do our analysis to make sure that's the case. And when it happens, it works well.
Yeah, I completely agree. And I think part of that comes back to track record again. I can tell everyone who's listening, honestly, that in 9 acquisitions, we've never failed to pay a seller note, and we've never had a rolled equity go to zero. In fact, we've had some very lucrative seller equity transactions. And so, that helps now that we've been doing this long enough. It's a little bit harder when you're first starting out to convince people that this is the right investment decision for them. We had one seller who post-closing told us the same thing. He said, I was happy with the 80%. The rest doesn't matter so much anymore. And that was a little frustrating to hear at the time, but ironically, what ended up happening is it led to a creative deal where he got bought out early, and that minority equity got transferred to his successor, the new management team that was taking over, which ended up being a good situation for everybody. So, we try and find creative solutions to problems when they come up.
Sure. Makes sense. I guess to that point, relative to kind of ownership and management and hitting that third prong, how do you have the discussions relative to transition? Because there are some buyers we've worked with that have said, "Yeah, this company seems great. We'd like to buy it. We just need ownership to stay on for 7 more years." And we say, well, we would say to our clients is we're not going to turn your ownership into a job. Now, at the same time, if it's a company that, particularly if they have their hands in the sales execution or operations, like they can't just give you the keys and say, "Hey, hope you like the house," and leave. And so that's always a negotiated point. We always figure out kind of the optimal tapering schedule based on the objectives of the seller. But how do you guys go around those kinds of conversations? Because I imagine they come up in all your deals as well.
That is the most common area of debate in the deals that we look at. I think the best case scenario for us is when there's an owner who's looking to sell for a non-retirement reason. You know, we've had one that was a divorce. We've had another that was, family estate planning type scenario. And for us, that's perfect because we understand that the seller wants to stay on, wants to continue being involved, but for some fundamental reason has to sell. But those are rare. I think the most common reason owners look to sell is eventually they want to retire or somehow transition out. And in those cases, we have to first ask ourselves, what does the company look like without this person? How critical is their role? How much of a secondary management team is in place? Are we confident that the business is strong once they've exited? And if the answer is no, we can still buy the business, but that's going to impact the transition period we ask for.
Sure.
A business where the owner is already out and already has a management team, we can have a pretty short transition period there. But if the owner is still the head of sales and the head of operations and the key relationship with customers and et cetera, usually we're going to ask for 2 to 3 years to transition all of those roles properly because that's how long it takes.
Right. And pragmatically speaking, if that is the situation, it's hard to argue that that's not necessary to not create a disruption in the business for the employees and stuff. But we get it. And that's a similar kind of main talking point on our side of things too. And so it's taking then to prong 4 and kind of one step beneath that relative to the employees. I know we talked about kind of the evaluation of employees, but how do you guys go around the conversations of retention of employees, particularly where they are important to the ongoing kind of continuation of the business? I remember back in the day when I was in New York, I worked at was kind of the internal private equity firm at Cantor Fitzgerald or private equity arm. We were consolidating real estate services companies. You had a lot of brokerage, appraisal companies like that. So heavy relationships, and the relationships were extremely kind of dispersed. And so you had to kind of go on a marketing spree to all of the employees to make sure you retained enough of them with the acquisition. But and there's obviously other businesses where it doesn't matter quite as much. But how do you go about those conversations or kind of trying to ensure the optimal retention of the key people that may not be ownership of the business?
Yeah, I mean, that's critical. We always think of companies as just a collection of people, systems, and processes. And so without the people, what do you have? Usually not a lot. So I would say that the first thing we do is during diligence, we try and identify any concentration risk from an employee perspective. Is there one person who has the majority of the relationships or the majority of the knowledge over a certain domain? And from that, we get an understanding of where are the weak spots in this organization from a retention standpoint. Who would be devastating to lose? And oftentimes, most of the time, within the first 12 months of buying a business, there'll be a meaningful increase in compensation given out to the broader employee base, but it won't be symmetrical. It will be based on the people that we feel are most critical from a retention standpoint. And generally speaking, we want to make sure that the people that drive results get rewarded healthily for it. And so we'll try and build in more incentive plans, build in more upside for employees that can help us grow the business, because that's ultimately what we want.
Sure. Well, makes good sense.